So we are welcome back. Sorry, I needed to quickly take a break. So understanding the business of our clients. This is critical to the success of audit plan. This is critical to the success of audit plan. We need to understand our clients. In order to prepare the overall audit strategy and audit plan, the auditor will need to form an understanding of the entity and its environment. So we need to know much about our clients. How old is this client? Yes, the history of the client is important. We need to know how old are they in the industry. It determines a lot of things and how we are going to approach their audit. The industry in which they operate, we need to know. The nature and the competence of the management, we need to know. So who are the management staff? What are their names? What are their qualifications? What are their exposure? What are their experiences? And things like that. It's important. It's part of knowing your customer. The entity's internal control system, we need to know. So what are the controls that the management has put in place in order to run this organization smoothly, to detect and militate against fraud? Its current financial performance, are they doing well? Last year, what was their result like? This year, how far is their performance? We need to know. Reporting requirement and deadline, like we mentioned before. Any recent development like Corona in 2020, we need to know how it has affected them and how have they managed to stay afloat. Understanding our client is a requirement of our auditing standard. And it says identifying and assessing the risk of material misstatements through understanding the entity and its environment. So if we do not take our time to understand them, we cannot know where their risk areas are and whether there is going to be material misstatements or not, and how to set our materiality level. We need to know them before we'll be able to do and achieve that objective. We are moving on to risk assessment procedure. Number 8 on our slide, risk assessment procedure. Now we've examined what risk assessment is. Now let's know how are we going to carry it out. How are we going to carry risk assessment out? So those are what procedures entails. And one of the primary procedure an auditor must undertake is inquiries or inquiry, whether you come from UK or you come from USA. Inquiry or inquiry, and it simply means asking questions. We need to ask staff some questions so that we can know much about the organization. So inquiry simply means asking questions, relevant questions, to know in detail much about the organization we are trying to audit. Analytical procedure like trend analysis, ratio analysis. We conduct acid tests. We conduct current ratio, liquidity, or gearing ratio, and the like. These are under analytical procedure, and it actually helps us to determine how the organization is doing. So when we are talking about analytical procedure, we are talking about making sense out of figures. They said figures don't lie. We quite agree figures don't lie, but the truth of the matter is this: figures that will not lie to us must be the one that will follow its trend. If not, figures can disguise. So we need to follow through the trend of figures that we are having. Like for example, if we do not do our analysis correctly, it's possible that an organization is still making profit, but they are making profit at a downward trend. But analysis is going to reveal it to us when we compare 2 years together, 2 or more quarters together, begin to see trend. And that is advantage of analytical procedure. Observation is part of what an auditor must do. In fact, it's critical to the success of an audit. An auditor must be able to observe. So what's observation? And how is observation different from inspection? Inspection also is a procedure. So let's take them one by one. When we're talking about observation, we're talking about an auditor not getting physically involved to a large extent about what he or she is observing. But when we are talking about inspection, just like a sign, it means going around. It takes a step further from observation to physically getting involved. When we are going on an inspection, we must be ready to carry, to observe. Let me give you an example. If I come to class now, I could observe by experience or by what is going on. Who is listening, who is not listening, who has gone out of the class, who is coming in. That is simply an observation. I can tell you, okay, 2 people did not come to class just by observation. But when we are talking about inspection, you need to carry that thing in your hand. Is it damaged? Okay, it's not damaged. What's the expiry date? And the like. So all those touchy aspects is inspection. Inspection gets involved. Carry it, examine it, write some observation out about it. So inspection is a step further from observation. Observation simply means, okay, let's say, for example, we want to carry out a petty cash audit or something like that. So if you just want to observe, you can just say, okay, petty cashier, please, can you count the money? Oh, okay, we have so number of so denomination, so number of so denomination, and you put it down. You then count it by yourself. You are simply observing. By the time you begin to count yourself and recording it, what you've observed, it becomes inspection. So these are risk assessment procedure that must be carried out. Moving on, business risk. Business risk. Like I said before, we must know our customer. We must know our client. It has a lot to do in helping us deliver quality audit. So what is business risk? It simply means a risk that comes naturally with that particular business. Every business has its own peculiar risk. Let's take coronavirus all over the world as an example. Coronavirus currently ravaging the whole world is a business risk to all businesses all over the world. But it's not a business risk that is particular to one field of life, one endeavor, one business, one industry. It cuts across industries. So when we are talking about business risk, we are talking about that particular industry. What comes naturally as risk in that industry. Like anybody that wants to sell kerosene must be ready for spillage. It's part of the business risk. We can now be talking about, okay, how are we going to minimize it so that it will not become abnormal loss? So that is business risk. So I read from our slide. Business risks are risks occurring as a result of significant conditions, events, circumstances, actions or inaction that could affect an entity's ability to reach its objective and carry out its strategies. Business risks can also occur as a result of setting an inappropriate objective, strategies, and goals. So that is business risk. We move on to understanding the control put in place by the management of our clients. Understanding the accounting and internal control system. This is very key when we are auditing whether a recurrent client or recurrent audit or current first-time audit. We must understand their system of internal control put in place. Understanding the accounting and internal control system. This is a requirement of our auditing standard, and it requires auditor to obtain an understanding of internal controls relevant to the audit. So for this process, how do you go about it in this organization? Let us know the processes. And when we are doing this, we need to flowchart it. That is, write something in form of symbol, how processes flow from one desk to the other, from one person to the other, and things like that. So that is trying to know how the system of internal control really works. The auditor should try to reach a judgment that is in his mind about how strong or how weak the internal control systems are. In our mind, as we are examining and they are giving us feedback, we need to decide, is this control actually strong or weak? Part of the things we use to achieve understanding or gaining an understanding of accounting and internal control system is using what we call internal control evaluation questionnaire. Internal control evaluation questionnaire. So it's a form or series of questions that we've written down, printed out, that we can give to, let's say, head of departments and managers to tell us. And this is like a survey that comes back to us, and we can gather more information about the clients. Also, We can gain understanding by meeting the staff one-on-one, asking them questions how they do things and carry out their assignments. Also, we have to leverage on our previous understanding of their work, and this is particular in case of recurrent year audit. Sorry, something fell down. Let's continue. Is previous knowledge of clients' complaint was brought to bear. Also, any recent changes must be examined. We must examine what is changing in the organization or what has changed in the organization. It's part of knowing our clients. Any problem in internal control, maybe that staff complain to us or the like, or management let us know, must be considered and put in black and white. The effect of any new, let's say, auditing standard or accounting standard and the like, how does it relate or affect this organization must be considered too. It's part of understanding how they work. Let's say they have accountants and certain things, new standard has come out and it's not being implemented and the like. We need to ask why it's not being implemented, and it's a signal to how strong or how weak the internal control system and management processes are. Last but not the least that we are going to examine is types of risk. The types of risk. We've spoken about business risk. Let's build on that knowledge or what we said business risk is as we consider other types of risk. We have basically inherent risk. We have control risk. Last but not the least, we have detection risk. When we are talking about the business risk, I told us that it's a risk that naturally comes along with that particular business. So that definition actually fits in for an inherent risk. So it is industry-specific business risk. You want to sell kerosene, know for sure it's going to spill because it comes naturally when you are loading or offloading. So it is inherent in that business. When we are talking about something inherent, it comes naturally. It is inherent for fishes to swim. It is inherent for birds to fly. So that is when we are talking about something being inherent. It comes naturally with it. So when a business risk comes naturally with a business, we say it's an inherent risk. Let's move on to control risk. The risk that the system of control may not prevail in the area intended. Don't forget that control simply means the procedures that management has put in place to run an efficient organization. So when all this system put in place is not mitigating or doing what is intended to do or achieving results, that is a control risk. So when a control will not achieve the intended result. That is a risk. Last but not the least, the detection risk. And the detection risk actually belongs to the auditor. Among the three risks that we've mentioned, this is the risk that actually belongs to the auditor. So detection risk simply means that the audit may not detect errors and misstatements that ordinarily ought to have been detected. So that is detection risk. Let me go back. There is more to that. Okay. So in the part 2 of audit planning, we are going to learn more about the model of risk. It has calculation too. So, but it's not part of this. It's treated in the part 2 of audit planning. And please don't forget to subscribe to us, GJAMES Associates. I want to believe you've enjoyed these slides. Subscribe to us, like us. We are value to life, GJAMES Associates. We are value to your business.